All right, welcome to our weekly Market Makers Mastermind. Today we get to jump into 3 case studies. Interestingly, depending on the market that you're in, you could be seeing all kinds of unique pain where you are. I know in a lot of the big markets in Florida, I know Texas the same way, Louisiana, we're just discovering the same thing, that properties are sitting longer, you're seeing more price, quote, improvements, and we're starting to see more short sales. So people who bought in the last couple of years, especially, if they got a low down payment loan, FHA, VA, USDA, 5% conventional even, by the time they list their property at today's prices and pay commissions and closing costs, and that's assuming they even took care of the house and it shows well, right? And they can command top dollar for it. Then they are, in many cases, having to sell the property short of what's owed or bring cash to closing that many of these sellers don't have. So if they don't have that, then we got to get the bank to take the haircut on a loan that just won't be paid off at today's market prices with today's cost of sale. And that is called a short sale. So more to come on that, but we're going to talk about 2 other ways that we solve problems for property owners. That in one case, one started as a short sale at a low price, and we propose to them raise the price, and then let's get that sold with owner financing in place. A lot of benefits in doing that, obviously. So we're going to go into those 3 case studies. Specifically, you'll see actual live addresses, actual closings. This is where we get into the meat of these phone calls, is when we're talking about these case studies, what the seller situation was, what the buyer situation was, how we solved the problem for the seller. And again, it's all about having different solutions in our back pocket. By the way, Fed, did you have a question you want me to address really quick before we jump in here? Or you want us to catch up with you after during the...
Yeah, sorry, I actually forgot to put my hand down. Yeah, it's I would like to go over the question, but it can wait for later. No problem. I'll put it down right now. Thanks.
Awesome. All right. So if you haven't been on here before, we try to keep these to an hour. Sometimes they'll go longer, but we are recording this. So if you happen to miss part of it, or you happen to miss one of our weekly phone calls, you can always jump on our Facebook page. And if you don't know, if you're not in our Facebook group, guy, by the way, I just posted the link to it in the chat. So go ahead and go into the chat, jump into our Facebook page if you're not already in there, because that's where you're going to see all the posted recordings from every single week that we do this. Usually the recording's posted the day after, so on Thursdays. And in every one of these, we try to give something juicy away. We're putting the final touches, as you heard me mention last week, about the short sale roadmap, which is the free online video course that takes you through the 6 steps of closing a short sale, listing and closing one, and then also how then do you find more short sales at a time when we're seeing these short sale listings starting to grow. So we're going to get you in front of that business so you can dominate while the competition's still kind of floundering and reacting to what's happening in the market right now. So if you don't know what this is about, it's basically for people who are lifestyle focused. It's for agents. It's also for investors. A lot of times you're both a licensed agent who also invests yourself. And in doing that, you accumulate lots of tools. So one of our philosophies on being effective is to, number one, always zoom out from a wider perspective, 30,000 foot view, to see really what's going on in the market, and not just only see what we want to see as licensed real estate professionals, and be, unfortunately, ineffectively hopeful, right? We don't want to do that. We want to have some foresight and be proactive when it comes to what's coming on the horizon. And that's what this is all about, is getting in front of the market as opposed to reacting to it. So what we like to cover on these now, we're kind of getting past the foundational training. We're diving in now to a lot of case studies. What are people actually doing? And this, I'm gonna kick us off on this particular training with 3 case studies. But as you guys surface deals that you're doing as investors, or solutions you're providing to sellers, then bring those up so we can feature those. And then more of the conversation is going to be about what you guys are doing, so we can all share what we're doing in the trenches in our local markets. So a little bit about us without going into too much details. If you know anything about us, we've done a lot of transactions, development game. We've been in education, working with licensed real estate professionals and investors for a lot of years. Me personally, 30 years in the business, right, as a licensed real estate agent. And I think what one thing that we're most proud of with the agents that we work with and the solutions that we're providing is that you've heard me say this expression over and over again, is that if you're a hammer, everything looks like a nail, right? If you're a listing agent, everything looks like a listing and putting something on the MLS. If you're an investor, maybe everything looks like a cash offer. But if you're an investor agent and you bring multiple solutions to the table, like you will see today in a couple of these case studies, we were wearing multiple hats. In one case study, I'm looking at it from a personal buying perspective. Then I'm looking at it as an investor. And then we look at it as just someone putting together a creative finance transaction. So it was like 3 different solutions or approaches on one particular address. So we'll walk you through what that looks like. So to dive right into it, we'll try to get the content out of the way in the first 10, 15 minutes. And then we're going to jump right into, so I'm only going to spend a few minutes on each one of these just to prompt questions. And then we can dive deeper if you feel like you want to know more about these. If you have your own case studies, then just put your hands up. If you have questions throughout, just throw your hand up, and then Chad and I will monitor the chat and get to you. But don't feel like, don't be ashamed to interrupt, all right? So stop us if you need us to take a break and address something that we're talking about here. So this, interestingly, this property right here, the property was actually listed, funny enough, for $360,000. The sellers owed $375,000. So right out of the gate, the listing agent recognized this as a short sale because it would legitimately appraise probably for about $390 today, based on what these comps are doing on recent sales. So if you sell something for $390 and you owe $375, there's only $15,000 there to cover commissions and closing costs. And so by the time commissions and closing costs would have been paid, seller would have had to bring cash to closing, and it's money the seller didn't have. In fact, they were ready to stop making their mortgage payments altogether. So that was an obvious short sale from go. So the listing agent listed it as a short sale. I'll show you the price history right here. So you can see that it was listed in December of 24 for $360,000 as a short sale listing. What we proposed the listing agent do was raise the price to a number that would clear the commissions and closing costs and keep that loan intact. So we structured essentially a loan wrap. In other words, the seller's loan for $375,000 would stay in place, and they have an outgoing payment for that loan, right? Well, if that $375,000 loan is in place, and I believe that loan was at like 4.75% interest rate, so they have this payment of, let's call it $2,000 a month that's going out to pay that loan. What they did was they financed the buyer a loan amount that matched their underlying loan, but at a slightly higher interest rate. So the payment that's coming in on the financing the seller offered a buyer is this much. And then a servicing company gets put in the middle of them. So the buyer and the seller don't have to interact after closing. And that servicing company takes the payment from the buyer every month, and then makes the payment on the loan payment, the underlying loan, every month. And then the seller gets a check for the difference. In this case, it was just a wash. So the payment that the buyer was putting up every month on the financing covered the underlying mortgage payment. And so in that way, you avoid, how many of you guys familiar with subject to transactions, by the way? If you do subject to transactions, you can comment in the comments and let us know. But that way we avoid a subject to transaction that exposes the seller to a lot of risks that a loan wrap transaction like this using a trust structure does not put that seller in front of that harm. So if you are an agent and you're not familiar with subject to transactions, you're starting to see a lot of those offers, right? So a lot of you who have listings out there, you get these subject to offers, and there's a way to counter those offers. We're not going to talk about that today, but it's a way for you to leverage those offers as opposed to just discarding them altogether and just dismissing them as, quote, unsafe or something that your seller doesn't want to do, right? So in this particular case, look what happened. Initially, the seller was going to have to go through a 60-day to 120-day short sale process, also not knowing, there's no guarantees with a short sale, right? You don't know how the lender's going to react. And we'll learn that in our third case study today, where the lender came back unrealistic about the price of the property. So we don't know how the lender's going to react. The short sale is going to ding the seller's credit. to some degree. It's not nearly as bad as a foreclosure, right? But if the short sale doesn't work, then a lot of times these end up in the foreclosure territory as a foreclosure sale. And now you're really hurting the seller and their credit. And it's not a way for them to get out from underneath that loan with some dignity, right? Because it's very embarrassing to have to deal with that and to put your family through that. So in this case, we actually increased the price and got the seller out whole, with the seller able to get another loan right away and not have that damaging effect on their credit and not having missed one mortgage payment. So the seller didn't make anything at closing, but they were able to get out from underneath the loan 100% whole and not have to go through the short sale process or potentially end up as a foreclosure sale on something that just was not moving, right? Any questions on case study number 1?
The other benefit there is instead of losing credit score, someone else is building their credit score.
Yeah, exactly. Because now that mortgage payment's being paid by somebody else. And, a lot of times what do owners do in this situation? To try to stop the bleeding, in some cases, they'll say, well, let me just rent the property out then and wait until the market corrects a year or 2 years down the road, potentially, so I can get out whole from this thing as my principal balance goes down and as the property value potentially goes up. Then I can sell it later, but at least for now, I can stop the bleeding, at least to some degree. But if that property was going to be rented out based on the principal, interest, tax, insurance, HOA, not to mention maintenance costs, property management fees, and so forth, they would have been still negative cash flow, a few $100 a month. And then you're just paying to wait out, potentially getting out from underneath a short sale, right? As opposed to just bringing closure to the whole situation, which is what we're able to do. By the way, anytime you talk to a property owner and you hear the R word, the R word is rent. Whether they want to rent the property out while you're talking to them about a listing, or you're 4 months into the listing, it's not selling, and they say, you know what, my plan B is I'm gonna let this listing agreement expire and go rent it out. If they ever say the R word, then that's a perfect opportunity to introduce owner financing, because think about it, they're going to have more net cash flow as a lender as opposed to a landlord. They're not going to have to be on the hook for maintenance, and they're going to get a big down payment in their pocket with owner financing as opposed to just renting the property out. So a lot of different advantages. So this property right here is on 40. Oh, sorry guys, I was going to give you the address. 4628 Treetop Lane in Edgewater, Florida. This is the one, Chad, you know about. It's not too far from where we're located. And, when I was looking at this property, guys, I was wearing my personal purchase hat. Okay, so I'm actually looking for a property, funny enough, where I could put my mom, because she's getting older, and I'm going to have to keep her close to me and take care of her. I just don't want her in my house, though. So this is a great way to kill two birds with one stone, right? So I was going to have her in this property right here, and then we're going to be in the big house. But wife ended up not liking the road out. So it started as a personal purchase where I made an offer, and here's a snippet from the actual letter of intent that was accepted by the seller. Now watch what happens when you can wear multiple hats. This is like a perfect example of this, right? So you look at something from a personal purchase. That's plan A, right? Now I'll show you how it fell into plan B and a plan C, and we solved the problem for the seller that actually worked out better. So in plan A, I made an offer for $575,000. Now keep in mind the property was listed for, I think it was 700 grand, about 699 or 690. So they had it listed for 690. I came in at 575. And by the way, they weren't wanting to do owner financing. This is what we call investing in the offer. Investing in the offer is when you make a relationship, you have conversations, you win trust and rapport, and you're able to massage an offer into that a seller is okay with, that initially they wouldn't have been okay with. But that takes time. It takes FaceTime. It takes, being on the call. It takes them seeing effort of you driving out to the property. This is why a lot of people who make blind offers on houses don't have the same progress in getting deals as people who, quote, invest in the offer. They go see the property, number one. I mean, as listing agents, we know that too, right? If you haven't even seen the property and you're trying to make me an offer and you're expecting me to be serious about it, it works and you can do it on a volume basis. But if you want to take a more surgical approach, which is the way we approach buying houses, then I want a relationship first and then business second. right? And so that's kind of how this went. So the seller, first of all, I'm coming in really low, about $100,000, more than $100,000 lower than their list price. And by the way, the listing agent was 30 days away from this listing expiring, and the seller wanting to just rent the property out, right? So when I introduced the idea, because it wasn't offered as owner finance listing, of financing some of that sale price, and the way we ask a seller to do that, by the way, we don't say owner financing. Literally the way I say this to a seller, and this is something you want to write down, is if I'm going to introduce the idea of owner financing on my offer, I'm going to ask the seller, hey, if I'm able to get you a price of X and get it closed within 30 days, and then I'm telling the gatekeeper, the listing agent, and get you your full commission out of this thing, would your seller be open to taking a down payment, and then the rest of the sale price, they take payments over time so they can net more money in total? That's literally how I say it. So are they willing to take a down payment after I pay them X, close it in 30 days, so it's a nice frame, and they take payments for the balance of their equity over time? And in that particular example, they said, well, we would want 40% down. I'm not ready. There aren't too many people that want to put 40, almost half of the purchase price down as a down payment and finance a small amount. So what they ended up doing, though, is they took this offer right here. And here's how I frame the offer. If you're ever going to make an offer and you want to make it look the absolute best, add in the interest on the loan. So if you can see here on the right, when I made the offer, I told the seller, look, I'm going to get you $712,000 for this property. I'm not talking price, though. I'm talking, here's how that 712, I arrive at that 712, but I hit them with that number right up front, and that gets their attention. So I'm gonna get you 712. Here's how I'm arrive at that 712 for you. I'm gonna give you 50,000. It's gonna be a purchase price of 525, of which 50,000 I give you up front, and then the balance of it you'll finance over an 84-month period. And my payments over that 84-month period are going to put $137,000 of interest in your pocket. So it's basically an income stream that I'm creating for you, because look, they were going to rent it anyway, right? But they were going to be negative cash flow if they rented it, as opposed to now positive cash flow, no maintenance, and some money in their pocket, their down payment. So $137,000 of total interest on top of my purchase price and down payment, and that's $712,000 that you're going to put in your pocket. So I frame the owner financing with the total money they're going to put in their pocket, and then I break down how I arrived at that number. And by the way, that happens to be on the side here, right? A purchase price that's lower than what you're asking, but I'm going to still get you a number in your pocket that's higher than the list price. And that's how we kind of frame that. So they accepted it. We went out and looked at it. And because of this dirt road out front, it's just too dusty for the cars. And there was some cosmetic work that my wife knows I'm not very domestic. I can flip a house and pay for that stuff to get done, but if I have a drywall patch that I got to do, it'll sit for till we probably sell the property, and it comes up on the buyer's inspection. So she knows I wasn't going to do that. So long story short is we walked on the offer, but here's what just happened. Look at the posturing that we did with the seller now. The seller, then we said, why don't we do this? We kept it under contract. We went out there and helped the buyer find the listing agent find another buyer. That buyer, look what they ended up selling it for, to another end user. They sold it for $650,000, so $75,000 more than my price of $575, and they got double the down payment than I was willing to offer and a shorter balloon period. So now the seller, instead of having to sell me at $575 with $50,000 down at, what was that interest rate? A 4% interest rate. I think they got like a 5.5% interest rate, $100,000 down, and they don't have to wait 7 years to get paid off. They did it in 5 years. So they made a whole lot more money with this end buyer. And then we made some money helping that listing agent get this thing done with that end buyer. So this is another way that, look at the 3 hats I had to wear for this particular deal, right? We wear a personal purchase hat. Then I wear my investor assignment fee hat to help them wholesale it to another buyer. And then we wear a transactional hat just to help them get it closed. So that's another way that we can solve a problem for a property owner wearing 3 different hats, 3 different solutions, 3 different roles. On this third case study here, this was actually a short sale. And this was a unique one because short sales, the lender wasn't reacting the way we expected them to react. They're pretty unreasonable about the sale price. So if you guys don't know what a short sale is, it's when you have to sell a property short of what's owed on it. And you have to get the lender to approve that because the lender is the one who takes the haircut on their loan balance, right? So that's what we help listing agents and sellers do. Well, in this particular property right here, it was listed on the market for $435,000 initially because the listing agent was trying to sell the property so that the seller could get enough money to pay the commissions and closing costs and still be able to pay that whole loan off. But the property sat for months at that higher price. Eventually they get down to $399,000, $385,000, and then they're in short sale territory very quickly. So they dropped the price to $350,000. They got 3 offers. The listing agent got 3 offers subject to the bank's approval, right? So even you could sell it for $1 and the buyer and seller can sign it for $1. But you have to, the disclaimer there is that the lender has to approve it, and that's the short sale process. So long story short, part of the short sale process, the most critical part is valuing the property because the lender wants to know what the market value is. So they send a BPO agent out there or they get it appraised. And then that BPO agent came back and said it's worth $330,000. The bank, even though they had an offer in hand for $350,000, they said we want $375,000. And the BPO agent just told them it's only worth $330,000, right? So that buyer fell out. The agent went back to their 2 other buyers, their backup offers, and then got it done with a cash offer at the $360,000. The bank took the $360,000. So we're able to get that one done and get the agent paid on it. So credit to the agent because the agent followed up on all their backup offers and was able to get it done with a backup buyer on that particular deal. So that's another example. And by the way, the reason that became a short sale to begin with, this is where you come in helping people as a short sale specialist, is you're touching people at a very emotional time in their lives when they're pretty much throwing their hands up on hope. They're dealing with something very traumatic. A lot of times it's medical issues. Sometimes it's a job loss. Sometimes it's a divorce situation. In this particular case, it was a job loss. And so the family had to move out and move in with their grown parents. And they had to sell this property and they couldn't keep carrying the monthly payment on the house. And it was worth less than what was owed. So they just made a business decision that they just were going to stop paying on it and then talk to the bank to see if the bank would take the loss on their loan. And so they'll be mortgage ready now. They avoid a foreclosure sale. They'll be mortgage ready now in 2 to 3 years, assuming they keep their credit up otherwise. And they have a clean slate and they're able to sell the property with some dignity as opposed to potentially losing it to a foreclosure sale, right? When the market was telling us it's not worth enough money to pay off that loan. So that's how we're to help them. So Chad just kind of put in the chat there that we are going to be, oh yeah, there's a consideration of value. If you guys happen to miss it from the session that we did last week, the consideration of value is a tool. It's 4 pages. It's a document that you want to give to that BPO agent so that that BPO agent is very reasonable about the value, can accurately peg the value of the property. Because what happens if the bank's BPO agent who's evaluating or checking the value for the bank's behalf, on the bank's behalf, comes back and gives them an unreasonable price? It's like blowing up a deal because your appraisal came in short, right? It's the other way around. So they overvalue the property and that it can kill a short sale. So you want them to have realistic valuation of the property. So if you click that link in the chat window, it'll take you to the recording from that week. And then behind that form on that page, you're going to be able to download that consideration of value so you can hand that document off if you're dealing with a short sale. So the other thing that you mentioned, you heard us mention last week, is our short sale roadmap course. Again, free. It's just basically to equip you with the 6 steps of listing and selling a short sale. How do you find those NODs and lis pendens? How do you contact them? What do you say when you contact a property owner who's missing mortgage payments so that you can turn them into listings and deals for yourself? And then how do you get that short sale executed? So to the finish line, so you can get paid on it. We're laying that out, putting the final touches on it as we speak. Should be out tonight. So when we post the recording tomorrow, you'll see it then. Okay. So appreciate you guys being patient with us on that front. So with that, guys, let's jump into our discussion now. What are you guys working on? Do you have any questions? Anything that you want us to cover? Fed, what were you going to ask about? Did we address that?
Hey, sorry about that. I was trying to unmute you. I was actually going to go back to what you guys were talking about for trusts, for I think living trusts. So I'm actually helping a client right now acquire a pretty important asset, and they're actually buying it as a vacation home here in LA. But what do you feel is the best way to introduce just the whole trust argument or conversation with them once they acquire the asset?
You could have them. I know Chad's got a good answer for this. You could have them just chat GPT. Why should I hold my vacation home in a trust? And that'll break it down pretty good.
Fair enough. Fair.
But I'm assuming you have good rapport with them. Like you have a good relationship.
So they were referred to me from a past client. So I mean, we get along very well, but I've only known them now for about 10 days. So yeah, pretty good rapport. I wouldn't say I've known them for forever though.
But they have a significant net worth, and you know that, right?
Yeah.
Okay. Are they using financing for this purchase?
They're buying it cash.
Oh, okay. Then that's one hurdle out of the way. I would just approach it and, say, listen, do you guys have a trust, or would you like to write the purchase, the offer in your personal names or an LLC? And that's your opener. If they say they don't have a trust, they're like, well, that's something you should consider. You can tell me to stop at any time. But as your fiduciary, I think it's my responsibility to help you decrease liability, both legally and within the family. So I tried to, I've done a lot of transactions in the probate space, and I've seen a lot of families in California struggle for 18 to 24 months because of the backlog in our court system in Los Angeles. And I have to have this conversation with every client. Like, if you have over a 6-figure net worth and you don't have a living trust, that's something I feel obligated to help you with as a fiduciary, even if it's just me introducing you to a legal professional that I trust. So would you guys be interested in learning about, how a trust can help your overall estate, but also why it's one of the smartest ways to hold a vacation property to limit liability?
Okay. And I have two sub questions to what we're talking about. I guess maybe this one we can answer secondly. The first one is I told you they're paying cash. In the event that they don't pay cash, what were you going to say about that? But before we get to that, would the whole trust thing protecting their liability also be would it also be worth it for them, given that they live in Indonesia and they come to LA, I don't know, maybe 3-4 times a year for about 3 weeks at a time?
Mm-hmm.
Would you still recommend them having their asset protected by a trust?
Because they're international, I may actually take this to a different level of professional, and you might want to consider a NIVAS trust, like an International Asset Protection Trust, or an IAPT. Okay. So the trust will actually live in NIVAS, but the assets will be held in Belize. And that's a very old billionaire's trick that few know about. But for about $50,000, you can configure a rock solid International Asset Protection Trust. That is the ultimate level of legal liability, because in order to sue somebody in that trust, you have 3 layers of attorney-client privilege in 3 different countries. So you have to get subpoenas through 3 layers of attorney-client privilege to even find out who owns one of the assets in one of these things. They're not recorded, so it's extremely discreet. It's if they're a very high net worth family and they want to be below the radar, this is how you do it. I have two professionals that structure these types of trust, and it's very sophisticated, but in concept, it's very simple. So anyway, I can send you a couple of people to talk to that I've vetted to help wealthy friends and clients. But that might be in their best interest, depending on what their overall estate looks like and how many countries they hold assets in.
Yes, that would be super helpful.
Okay.
Should I email you about that, or
Yeah, just send me an email and I'll pull both of those contacts for you.
okay. And then in the event that they randomly decided that they did want to finance, even though I doubt it, since this can likely come up with other clients, how would you structure that?
Yeah, banks don't like trust for the reasons I just said. They're extremely hard to recover assets from, if not impossible. And
Right.
especially the IAPT is so far bulletproof. There are over 2,000 case laws on that structure, and one's never been pierced. And there are state level asset protection trusts, like Wyoming has a good one, North Dakota has a rock solid one, but there's only 12 or 14 case laws that are precedents that support that structure. But so banks don't like it for that reason. If somebody defaults, they can't recover from the trust, or it's extremely expensive. In the IAPT structure that I recommended, you actually have to fly to the Cook Islands. You have to pay a $150,000 fee to actually file the lawsuit. And then the litigation starts, and you have to support that. But it all has to be fought with local attorneys that charge sky high rates for this reason.
Mm-hmm.
So the banks just don't want to lend to trust. Now, there is, and John, you might have to back me up on this, and in the 1950s, there was an act passed that actually allows assets to be transferred, even with notes attached to them. You can transfer in trust without triggering a due on sale clause. Do you remember the name of that act, John?
Yeah, it's the Garden St. Germain Act, and to Chad's point, it basically allows you to put an asset in a trust, and it makes it federal. It's a federal law, so it applies everywhere in the U.S. that it's illegal for them to call the loan due if it's a revocable trust.
So just laying context here, Fed. So what I would do is close that. Probably for a sophisticated client like that, I would form a new California LLC if it didn't affect the loan product. I'm assuming this is a non-QM loan, so it's probably not going to raise their rate. They could close in their personal name because they might only have a day of exposure, but close it in their personal name or in an entity, and then fund it into the trust post-closing. And that act will protect them, and the lender can't, they can't do it. Would make it very difficult for the lender to recover, but it's their chance of default is very low as well, right?
Yeah, pretty much. I mean, never say never, but the probability is really low. Yeah.
What's the loan terms are getting on that purchase, by the way, Fed?
Well, they're not getting a loan. He communicated that he's going to pay cash, but
Okay.
I have had clients who, in the same kind of ballpark, told me they were going to pay cash, and then last minute said, "Hey, I don't want to park that much liquidity into this, and I want to invest it elsewhere, so I will get a loan."
Okay, cool. Awesome. Thanks,
Thank
Fed.
you. Appreciate you guys.
Yeah, absolutely. One of the benefits too, if they ever decide to sell the property, we've dealt with this with foreign sellers, is if they don't want to have that 30% FERPTA withholding on the sale of the real estate, if you don't trigger the sale of the real estate and they own or finance the property by selling the control of the trust, which is what we structure for them, then they're not triggering a saleable event. So it's not a taxable event because they're not conveying title to a buyer. They're literally just offering financing for a buyer, getting a down payment for the control of the trust, which is a personal property transaction. It's not a real estate transfer. And they're able to then sell the interest of the trust on the condition that the buyer performs on that note. So it's a conditional trust interest that they're selling. And in that way, they're able to then avoid the FERPTA withholding until the buyer eventually purchases the property out of their trust in the future. It's a great way to convey control of a property and finance that buyer who otherwise either doesn't want to pay today's prevailing rates or go through today's financing, or just can't get a loan right now.
Fair. And actually, I mean, I would have preferred obviously just to have them avoid paying capital gains tax, they own a condo here, and they're going to want to get, I know that in it, essentially they're going to want to buy this new house first and then sell the condo so that they still have a place to be in. Feel like doing it that way, buying the house first and then selling the condo, is not going to avoid a 1031, because
Oh, you just cut out, Fed. Nope, he's not in a good service area.
Fed, I'm going to assume you can hear me, but for the sake of the value of everyone else here, what he's talking about, I want to add something there. So he's worried about the tax strategy, the timing of they want to purchase the asset cash and then sell another property, which won't allow them to 1031 into that. There's a simple solution to that too, Fed. If you look up Delaware Statutory Trust as another billionaire loophole that's really interesting. So in lieu of a 1031, they can invest in a private offering like a 506B, like a syndication. I have two vetted ones. One is Amazon warehouse space in the New England area. The other is a mainstream supermarket chain. So these are commercial real estate deals on typically on 30-year triple net leases. But it's structured as a fund, so money can come in and out like it's an open fund. So rather than worrying about the 1031 game and all the rules and crap that come with that, they can sell the asset and just roll the investment into a Delaware statutory trust as a syndication. And for everyone else listening, I'm only recommending this because we know they're accredited investors, which means they make over $200,000 a year individually, over $400,000 as a couple filing jointly, or they have $1 million net worth excluding their primary residence, or they have an LLC or other entity worth more than $5 million. If they meet that requirement of an accredited investor in the eyes of the SEC, then they're qualified to invest in these private offerings. And these are usually structured as a syndication or of 506 Reg D. So look into that. I can also give you the contact. I know that was a lot of information. I can just give you a phone number to a really friendly guy in Philadelphia that vets these, and he is a registered investment advisor, but he doesn't deal in retail. He only deals in these types of alternative assets for ultra high net worth.
Chad, if they were to roll in the proceeds into the DST, would they still need an accommodator the way you do for a 1031?
No, there's a different set of advisors for that. So it's kind of like when you put a certain amount of money in a bank, you no longer deal with the business bank manager. You get transferred to the wealth management department, right? So it's under a different set of rules, a different part of the tax code, but it does have all the benefits of a 1031 without all the urgency and headaches.
Okay. Yeah, no, I'll maybe I'll email you and maybe you can put me in touch with the gentleman you were referring to.
Yeah.
If that's cool.
Awesome.
Super helpful. Thank you guys.
Yeah. Thanks, Fed. Isis?
Yes.
Yeah, you had your hand up?
Yes. How are you guys?
Good. How are you?
Doing great, thank you. So I have this buyer. He wants me to offer a seller to see if they can do seller financing because he has some cash, but he cannot do financing at this moment. He is one of these people who don't believe in banks and have the money, in the house. And he has a lot of cash and he wants to buy a property. How can I offer or how can I ask a seller to offer seller financing?
Oh, that's a good question. How much cash is he talking about, and what's his intent with the property?
The house value is they selling the house for 209,000. He has 170 in cash.
Oh, so there's a specific house that you're looking at right away.
Yeah, right now he's looking at that house. But he's open to see more houses. So
okay. How much cash is he playing with? So, you said 170 total.
He has 170 total.
Okay. Is he buying for investment reasons?
No, he wants to buy for first home buyer, like he first home.
Oh, gotcha. So he's buying for his personal use.
Yes, sir.
Okay, so that opens a lot more options, because even with owner financing, unless you get a ridiculously low rate, and I'm
Mm-hmm.
talking like less than 3% or principal only payments, no interest, it's very
Mm-hmm.
hard to get properties to cash flow right now. So if he's looking for personal use and he's got a substantial down payment of 25% or more, which he clearly does in this case, then he can easily buy properties with owner financing. I can show you how I'm doing this right now for a buyer who's putting about $80,000 to $100,000 down on a $400,000 purchase. And I
Okay.
can show you how I make, you guys want to see the email and how I make those offers, by the way? This is another training in and of itself. If you're representing somebody who has a pocket full of cash and you want to get a deal for them with better rates, no underwriting and no credentialing and no origination fees, and make your full commission, if not more, then this is how we approach it. But Chad, you were going to say something before I jump into that.
Since there's a specific asset, I'm wondering, do you know if are there any mortgages on the home? Is it free and clear, or does it have debt?
The house is they have a mortgage on the house. The house is currently rented. So he wants to basically buy the house and wait until that tenant leave the house so he can live in the house.
Do you know what the loan payoff amount is?
No, I don't at this moment.
Okay.
Are you friendly with the listing agent?
I emailed them, no answer. So that was yesterday. So that's what I am glad that I'm hearing this today, so I can get a better approach to the listing agent.
Sorry, do you happen to have Stab in the Dark? Are you in Central Florida?
Yes, I am in Central Florida, Orlando.
Who's the listing agent?
Hold on. Give me 1 second. I can get you the info in a few.
Yeah. And what were you going to ask, Chad?
But the last time title transferred, when that seller actually originated that loan.
Okay, I can get that information.
Chances are the down payment of 170 will more than cover the note. I mean, chances are like far greater than not. So there, you wouldn't have to do a wrap. You could structure it in a trust. Like, you could still structure it in a trust if you'd like. But the language there is, it's easy to show the seller the benefit of that, because you're taking the risk of default away because the note goes away and they're carrying a first at a very low LTV. So it's very beneficial for them. They end up getting their full sale price and the interest for whatever the term is they agree to. So it's a very easy sell to the seller. If and where John's headed, I'm sure, is get in really good rapport with the listing agent, because they're the gatekeeper on this.
Yeah, definitely. And sometimes they don't answer, so.
Yeah.
Yeah.
This is one of those face-to-face, take them to lunch or have a drink, have a cocktail at happy hour and talk about it casually is usually a good approach for me.
Yeah. The
Nice.
listing agent name is Steven Coleno.
Okay, don't know him. So I'm curious, why is it that he wants a $209,000 property? He just doesn't want a big loan, or is he sensitive to a specific monthly payment? I'm
Yes.
asking because I'm wondering if he can get a lot more house for that amount of money.
Yeah, right now he's just looking to see the less payment he can do, the better.
Okay.
He's a retired person, so he just live on a base income, and that was the conversation that we had right now. So yeah, but that's what I'm here for, to get more information and then offer more options for him, basically.
Okay, gotcha. All right. Well, here's what I would do when I approach this, and then I'll send you guys, I'll show you guys the offers I was making for a buyer yesterday on something very similar.
I want to, before you jump in that, I want to suggest one more thing. Like what John just said, it could be some really good language when you're talking to the listing agent and the seller. With $170,000 in cash and no outstanding debt, my client obviously has options, but he really likes this house. So we came to you first. If this is something you don't want to do, just let me know up front, and we'll go find him another house, because you're holding the power in this negotiation in your market. But point out to them, like, he doesn't need this, but he's you're bringing a essentially no risk offer to the table that won't easily be replaced. And I'm sure you're aware of the market statistics here, but you could point to the climbing inventory levels, declining prices, compressing rents. But this should be a really easy sell if he wants to stick with that house.
Okay, great. Thank you.
So if you guys want to know exactly what we say, when you call a listing agent and you're trying to get past that gatekeeper to get a deal done, that involves owner financing, and it's not listed with owner financing, which, by the way, of the 78,000 active listings in the MLS right now in Central Florida, less than, I think the last time I checked, about 714 had owner financing. So barely 1% of all the active listings on the MLS offer owner financing. The same was true in Austin when I checked that MLS. The same was true in San Diego when I checked that MLS. The same is true in Atlanta when I checked that MLS. It's always 1% to 0.5% is offering owner financing for some reason. Yet the benefits are so extensive for the sellers. So when we call on those listings, first of all, I'm specifically targeting properties that have been on the market a little bit longer. So when I put in my search filters, I'm looking for, in my market, anything over 100 days, you're typically going to see price reductions, right? So if I've seen a price reduction or two, and I know it's been on the market 100 days or more, and then I put in all the other criteria that the buyer has with square footage, bedrooms, location, et cetera, then that produces a list, and now I have my target list. The first thing I do then is I just call the listing agent, and this is exactly what I say to the listing agent. First of all, I want them to know I'm not an investor and I'm a licensed realtor, right? So I'm a counterpart. I'm not an investor who wants to throw a sub-2 creative finance offer that's going to turn them off right off the bat, right? Or her. So I say, hey, my name's so-and-so. I'm with so-and-so brokerage. I'm on the MLS looking at your listing at 123 Main Street. I'm curious. It looks like a really nice property. It's been on the market, though, for 100 and some days. Is there something wrong with it that we can't see on the MLS? And I ask that because I want to agitate and surface pain, because I don't know where that agent is right now, right? That agent could be taking their kids to school, or they could be thinking about bills. They could be out at another property. The furthest thing from their mind is agitation and pain about this property. So I want to surface all of that before I come in and introduce a new concept to that agent, right? A relief valve to their pain. So they'll start talking about all kinds of things. Oh, they listed it really high price in the beginning, and now it's kind of a stagnant listing, and now we're chasing the market down. They'll say things like, oh, there's a builder across the street who's offering a similar floor plan, but they do rate buy downs at 4.9%, and the seller's they're trying to sell it for a comparable price that the builder's offering the same model. Whatever it is, you surface the pain. Then I say, well, let me ask you this. If I can, it's the frame, right? I always frame it first. And I'm always hitting them in between the eyes with the benefit to them. Let me ask you this. If I can get that list price that you're asking, because do we care about price if we get terms? We don't, right? So if we can purchase at that list price with my buyer and get you your full commission and get this closed within 30 days, that's all music to his ears, right? Or her ears. I can get you the list price. We can close in as quick as 30 days or sooner, and you're going to get your full commission as opposed to this potentially expiring if they keep chasing the market down. Would your seller be open to taking a down payment? And then remember what I said, the rest of the purchase price, they take payments over time. And then a lot of times they'll come back with, oh, was that a subject to, or is this and that? And then I address those questions as they come up. But I let them know that here's the situation. My buyer, kind of like just roll into what Chad was just saying, my buyer has options. They have plenty of cash. They have a very healthy down payment of X. Now my buyer has a down payment of 100 grand, but I'm starting at 80, right? So I'm starting at about 20% down. If you have a buyer who has about 20% down, there's no reason you can't find a buyer like that in owner finance listing today. It's very easy to do. There's so many out there right now that are just sitting. So if I can get them $80,000 down, and the example I'm about to send you guys, the email I sent, it was a $395,000 listing. So 80,000 down is right at that, that 20% range. Then would your seller be open to financing the balance and taking payments over time? And then I just want to find out, because I get them to a fork in the road as quick as possible. Are they open, or is it an end of discussion? Just get them to the fork in the road. And you get them there by just saying, here's my introduction. I'm an agent like you. I'm not an investor. What's the problem with this house? Play a little Columbo, let them surface all the issues, and then hit the relief valve. If I could get you the list price, get you your full commission, and get this closed within the next 30 days, do you think your seller would be open to taking a down payment? And then the rest of the purchase price, they take payments over time. And that's what gets the conversation going. And then it's always going to be, well, send me something. And then here's what you send them, right? So I try to put the whole email in a chat, but I'm just going to save this and turn it into a file for you guys real quick. And then send the file to you. And I'll put it on a Word so you guys can have it on Word. Owner finance email offer. And remember when I said we add up the total amount for the you'll notice in this file, I actually add up the total amount that the buyer is going to pay. Now, at this point, like Chad was asking, you need to know what the mortgage information is. So ISIS, once you kind of get that rapport built and you find out that the seller is open and the agent's open to doing owner financing, then I just say, look, if there's an underlying mortgage in place, and depending on what the balance is, if your buyer's going to just pay off the whole balance, it's a non-issue. But if that underlying loan is going to stay in place at some point in the conversation, you'll surface the principal and interest, tax and insurance breakdown, and then we can structure it together. We can do this for you. We can structure what that loan is going to look like that wraps around the underlying existing loan.
Okay, that sounds great.
Yeah, so let's see here. All right, so I'll send that to you here in a second, guys. But that's the way that we approach that. You should have no problem finding, and if it's not going to be that specific property, we can show you how to get them into another property very easily. Any questions?
Adrian said she's new to the mastermind this week. She's assuming you have everyone's email. Do you plan to email that handout, or do we just want to put it in the show notes?
I'm going to put in the show notes right now.
Okay. And for anyone listening to the recording, you can look below. You can download this.
So welcome, Adrian. What market are you in?
I'm in Central Florida as well.
Okay, cool.
Thank you.
I try to just paste the copy in the show notes or the chat window, but it will only take so much of the language. So I'm just going to put it on a Word document for you guys and just send you the document here in a second.
Okay, thank you.
Yeah. Any other questions while we're waiting on this file to render?
I had one for you to look at, Rex.
Okay.
Yeah, Rex, what you got, man?
Okay, so I'm the listing agent. It's my listing situation is hasn't been on the market that long, only 20 days. Seller is motivated to sell. We dropped the price considerably, about $24,000 about 10 days ago. We have been getting showings. I think he's a potential for owner finance. It's listed at 574. He still owes 520. We've been marketing it with an assumable VA loan at 4.625, but just haven't had any takers. So I don't know. He does have room. He's actually told me that if he broke even, he's fine because I guess he inherited some money. His pain point as far as timing is that he is buying a property out of the area. Signed his contract yesterday. Closing is June 4th. So I'd kind of like to get him wrapped up so he isn't carrying two mortgages.
Okay, so let me ask you again really quick because I was looking at a folder to try to get this file over to you guys. Sale price is how much?
574.
574. Loan balance is how much?
520.
574, 520. And so he's expecting to get what, like 15, 20 grand at closing?
With the commissions and closing costs, I haven't figured yet. About 20,000, 21,000.
21,000.
Net.
Okay, net at closing. And
Yep.
so, and he's willing to keep his financing in place for a buyer.
Right. Yeah. Well, right now we have it set as an assumable.
Okay.
You know, they'd have to qualify for the VA loan. His loan officer told him they didn't have to be a veteran to assume the loan, that they could take it, you know, take it over, and then he'd, you know, get paid the difference some other
Okay.
way, whether it be,
Rex, do you have it? Is it listed as owner financing available?
it's not listed as owner's financing, it's listed as assumable mortgage.
Yeah, that's one of the easiest things you can do is just check that box. That should definitely get you some additional interest, as John was pointing to earlier. And the reason it's eligible for that is you're going to, you know, the seller can carry a second for the delta. So you can say in the private remarks, you know, seller willing to entertain a second mortgage with VA assumption. And
Okay.
that one's pretty simple to structure, because that VA, as long as they qualify for the VA, which basically, when you're doing a VA assumption, I think the biggest qualification is your debt to income ratio, and if you have a 640 credit score or better. I think it's pretty simple. So you can justify pitching it as, you know, marketing it as a owner finance available, because you're likely to do a wrap on it.
Right. Well, what kind of down payment would we need to, you know, get
Well, the
that?
down payment. Yeah, if you're going to do a wrap loan like that, you're going to want the down payment to cover at least the commissions. The 20,000 he's going to want. Basically, the difference between the loan balance and the current sale price.
Okay.
Yep, is the down payment at a minimum.
Yeah, so roughly 50 grand in this scenario.
Yep.
Right. Okay, and okay, so the other the buyer is just taking over that loan. He's free and clear. The title goes to the new buyer, and he's out from underneath it. Correct.
And that 50 grand could come in the form of cash, or it could be some cash, and then the seller carries a second.
Right. Okay.
Either way, you're creating an asset for him, even with the debt instrument. And you could also, if he's subject to capital gains, he's probably not. It sounds like he's probably get the exemption. Has he lived there 3 of the last 5 years?
He bought it in July of 22, so we're coming close. we're coming close.
If you do the math, and if you figure out there is a capital gain liability, then the owner financing, carrying that small second and paying it out over time, as long as he doesn't have other long-term capital gains. If you keep him below 40, I think the limit's 40,000 still. If you keep his annual payments below 40,000, then he doesn't have to pay capital gains.
Okay.
So even if he doesn't have the homeowner exemption, if he doesn't qualify for the 3 out of 5 year rule, then the note could actually be a tax strategy for him.
All right. Let me look. He had sent me an email that he had gotten from the lender, and could take over the loan. Buyer assumes the loan. They cannot use a second mortgage for the $56,000 is what his lender told him, that's holding the note right now.
Is it a private lender?
It is Navy Orlando Federal Credit Union.
No, then we just do a loan wrap then. He doesn't, and keep it simple. And so we can talk about that offline, Rex.
Okay.
I'll send you my calendar link. But here's what I just put in the chat, guys. You can download this, and then we'll wrap up today. This was to a listing agent after I had the initial conversation. I've got a buyer. Here's a situation. Would your seller be open a down payment at this list price? So asking price. And then we get it closed within 30 days. Are they willing to take the balance of the purchase price and payments over time? And then I send them this, which is basically just a quick, like right in the jugular. I'm trying to get people to the fork in the road. Yes or no, yes or no, yes or no, right? So I make it as simple as possible, nothing salesy. It's just saying, here's a breakdown. As mentioned, we can close by the 15th of May. Here's the purchase price, which is the list price. We're gonna get you 80,000 down. And I clearly define that of that 80,000, the seller then would cover commissions and a $2,000 for a closing out of that, and they'll pocket everything else. So they know what the net is to the seller. I answer that question. And then here's the balance of the sale price, $315 at 4.9% rate, puts a payment of $1,672 in their pocket. And then at the end of an 84-month balloon period, which is 7 years, the loan balance is going to be $276, and they'll get that balance at the end. So the buyer's going to pay a total of, on a $395,000 sale, $496,000. That $496,000 is 3 different buckets of cash: a down payment for $80,000, monthly payments total of $140,000 over the 84 months, and then at the end of the 84 months, they have to refinance out that balance at $276 or write a check for it. Right? So you add all those up, and that's $496,000. Now, if there's an underlying loan, we would just deduct that loan, deduct the payment from the payments that are being made, and deduct the loan balance. When this 276 comes in, that pays off the underlying loan. So that's what we call a loan wrap, right? So that's what we would structure on yours, Rex, a loan wrap, if they have debt. Now, if the property's paid off, then this is literally the sale, what they're getting in their pocket from the sale of the property, minus the commissions and closing costs. And then we put some protections here on the way we structure these so that they don't have to worry about default in the foreclosure process. They're not going to have to deal with the borrower after closing, because a servicing company, a loan servicer, is going to collect the payment and make the disbursement to the buyer. And if there's a loan in place, they'll cover that loan payment every month. And the buyer's not going to be on the hook for maintenance or repairs after closing. So it's like 3 highlights or 3 points that a lot of sellers, or issues the sellers or concerns they'll have doing a structure like this, that they just, they're just ignorant. They don't know. Right. And then, thanks for your consideration. Here's my number. Now all you guys have my cell phone number. I didn't realize I put that in there. But if you need any help, just hit me up and I'll send you my calendar, and you can book on my calendar. And then I'm happy to do a 3-way call with your seller to cover, I always say, the numbers, the protections, and the process, because they want to know the numbers. They want to know how they're protected, and we'll walk them through the closing process. And that doubles as education for the listing agent too. So if you guys ever have a situation like that, we're happy to jump in and help out. All right. All right. With that, guys, if there's nothing else, we will call it a day. Any other questions, thoughts, insights, complaints? All right, guys. Thanks for joining us. We'll see you next week, and watch for the recording. Chad's going to post that tomorrow. It's also, you're going to get the short sale roadmap course tomorrow too. That'll be posted in the Facebook page. So again, if you're not in the Facebook page, find us at Market Makers Mastermind on Facebook. Okay. And we'll see you there. Talk to you soon.
Thank you, guys.
Thank you.
Thank you.
Alfredo, it's in the Facebook group, last week's recording.
Thank you, John.
All right. Take care, guys.